At the start of 2025, some of the biggest names in finance made confident predictions. By the end of the year, many of them were flat out wrong or badly off on timing. This wasn't about amateurs. These were elite hedge fund managers, star analysts, and the world's largest banks. Michael Burry warned that AI stocks were in a massive bubble. He positioned for a sharp collapse. But instead of crashing, AI leaders kept rising, driven by capital concentration, earnings resilience, and institutional inflows. The bubble never burst in 2025. Ray Dalio signaled late-cycle risks and bubble-like conditions. Historically, those warnings often precede market pain. But in 2025, there was no crash. Equities delivered strong returns despite elevated valuations. Tom Lee expected early rate cuts and a broad, smooth rally. Rate cuts were delayed, inflation stayed sticky, and gains were narrow. He was right on direction, wrong on timing and breadth. Dan Ives predicted explosive AI monetization. He even floated a $4 trillion valuation for Apple. Tech stocks did well, but monetization lagged the hype, and those targets weren't reached. Big banks weren't immune. JP Morgan Chase, BlackRock, and Bank of America all leaned cautious. They favored cash, defensives, or alternatives. Just as equities surged. The biggest mistake of 2025 wasn't being bullish or bearish. It was underestimating how long AI-driven momentum could override traditional models. It was assuming markets would behave on a predictable timetable. Predicting how stocks will perform, especially over a single year, is extremely difficult. Even the most experienced investors and institutions routinely miss on timing, magnitude, or leadership. That's why long-term investors tend to focus less on annual forecasts. Short-term narratives change quickly. Long-term fundamentals tend to matter more.